Hi, this is Cameron Mitchell. I'd like to take you through a little bit of intermarket analysis and using the ECRI toolbox. The ECRI is the Economic Cycle Research Institute. What is some of the stuff that they do is they release about every week leading indicators and recession alerts. As you can see right here, blue line kind of goes down here, gives you an early warning to the recession to when the market melted down. It goes back up. It never really dropped to the oil deflation. Then went back up shortly right after. I'd like to do two different things here. I like to do one for more passive, and then get into a little bit more active management of your portfolio. So first of all, we'll go to the CRY, which is the Commodity Research Bureau Index of the commodities. Oil is heavily weighted in here. I think it's like 40 or 50% of the weight. So it went up in 2008 and then gave a sell signal. Now what you do is you go through here, and the corresponding index to commodities is the TSX, which is a commodity it dropped, and this is the sell signal that you got from the financial crisis commodity CST, red CST signal. And you see that it would have never dropped. Check here. It's really cluttered, but as you can see, it's probably around there. So you probably wouldn't have got out till very far away because it did go parabolic. So it's good to have a combination of complementing analysis of using intermarket analysis and timing your trades in that sense. But this is basically a red CST for the commodities and the TSX back in, we'll say, Friday, August 8th of 2008. You would have got your sell signal on the TSX, and then you would have got your buy signal right here after it broke above the trendline resistance. Kind of just set right back up to see how it touches the points here, and drops again. So we'll see. So what date was that? March 3rd of 2009 is when you got your buy signal for the TSX. Okay, well, it would have been right here. Would have been a little bit more. You would have got your buy signal right here from the lows of 8,600. And you would have got a sell signal. Sorry, I'm just going off the scratch of this, and then I'll go up to the TSX or the S&P 500. And you would have got your sell signal May 14th of 2010. So let's go to May 14th, 2010. Would have been in around here is when you would have got your sell signal from commodities. Okay, so this is basically, I wanted to touch down on the 2009 trend line of the TSX. When it started going down, I kind of was a big proponent and had a huge bias towards it going down. I mean, when stuff goes down drastically, sometimes you don't know how whole the rabbit hole goes. So it dropped in September 4th of 2015. Let's just check out the CRY, which is the Commodity Research Bureau. It dropped in Actually, earlier than that, probably September. No, not September. July 13th or the 3rd of 2014. So you would have got an earlier sell signal to get you out of the market than using just basic trend lines on the TSX. And that kind of basically the way it works is commodities are a very trend-oriented asset class. They go through bouts of inflation and deflation, and currently, as we see, we're in after the 2014 and March 2016, we saw an uptrend after a multi-year downtrend. And currently we're seeing a reinflation of commodities, and that's what's kind of led to the TSX rebounding up to that amount. And you have to imagine that there is a lot of human behavior behind that. So both the Commodity Research Bureau Index is more you get earlier and later signals, or earlier sell signals, early entry and early exit sell signals, because there is a lot of human behavior within the stock indexes. People are buying money managers, large institutions, small speculators, and commercials. So you kind of get a mix of distortion somewhat, and that can definitely work in your favor because you can get out earlier and you don't have to experience the downfalls of, as you can see, you got a sell signal right here and it still went up weeks after. And look what happened after that from the Commodity Research Bureau Index. And currently we are experiencing a little bit of resistance from two trend lines. One is the 2009 trend line right here, the blue one, and just a downtrend line right here that we're experiencing. But you won't get a sell signal if you use intermarket analysis below here, this green line under this green trend line. That's when you kind of know that the trend is over for the TSX. So I'll go on to and another complement of the Commodity Research Bureau Index is the linkage between the US dollar and the commodities. Currently we're seeing a priced in rate hike for December of 2016. So we saw kind of break above resistance right here, and it's been going up for a few weeks. And if you look at the COT reports, the Commitment of Traders reports, you can see a large surge in buying in the US dollar by large institutions and that. But it does, back in 2014, the US asset would have been pretty good, US dollar asset, to ride up from about 78 cents on the dollar to around almost basically during the commodity deflation. That kind of broke out just as commodities were breaking out in February, just a month before. You got a sell signal in the US dollar. So that's when commodities started reinflating, and then it's kind of hard to tell and be able to common sense tell you what's going to happen. But what I see is there's inflation on the ECRI is at 99 highs, and you can see core personal core inflation is rising pretty fast. And there is a strong upsurge in that, and we're also getting leading indicators, as I'll point out, rising to over 2013 highs or 2012 highs, as you can see right here in the red line. And that, so that's if you're inactive. Let me get back to what I'd want to do, because of a lot of people have registered accounts and that. So I'll go over to, and the US dollar and the commodities are inversely correlated. So right now we're seeing an inflation of both, which is the correlations kind of mixing up. We're getting strong signals from the growth indicators and Also, rate hike probabilities are being set in, so there's buying speculation going on. Um, I want to take you through the passive investing for people who want to go in for the long term and don't want to become active managers and just want a straight buy sell signal every 3 to 4 years. So right here we got a passive investing sell signal, and this was back in 2007. Reason being is I'll take you to the ECRI, and we got a sell signal right there, and it dipped below 0, and that was the start of the recession right there. So it got you out basically at the top of the 2008, 2007 downfall, which never really happened until about 2008, but it got you out. And leading indicators usually lead the market about 3 to 6 months. So you got a buy signal here in 09, and I believe March. No, sorry, it was June of 09, which is right here when it reached above 0 again. And you never got a sell signal till about when the oil deflation started happening back in 2015. Gotten out of this whole ride up until about June or so of 2015, which would have been right around here, right before the major drop. As you can tell, it is a very good system if you can utilize it right, the passive investing system, because it allows you to not be constantly thinking about buying and selling. It doesn't take you into that sphere. You just basically a financial advisor would be helpful if you brought up to them this sort of investing style or strategy that you wanted to use, or you can even use it yourself. It's on advisorperspectives.com, and you just track the ECRI weekly leading index growth rate and the recession alert weekly leading index. You're going to want to follow the recession alert weekly leading index if you're a passive investor. And let me tell you a little bit about intermarket analysis and what you could have done instead of just holding your money on the sidelines, which a lot of people do once they realize that they're starting to get some negative returns, is to go into bonds or securities that are more fixed income. So let's say we got the sell signal in basically July of 07. Let's look at bonds. Okay, well, let me see here. Does it do 07? July of 07, okay. You would have got into bonds right here, and it's bonds and the equity markets are they complement each other well inversely. They're more known as safe haven assets, so people rush into them and rush out. This is a 30-year bond index, or 20 plus here, but it's the most volatile. I couldn't find one that went back as, I would have liked getting into the mid-range treasuries, such as the 10-year, which is more of a benchmark index towards bonds, and less volatile, so you wouldn't get the sharpest increases in the big draw, the pop and drops, which could be not desirable. So you got your sell or your buy signal right here after when the market started boiling down, and fixed income started rising as the market started melting down, and that's when you got this sort of rise right here in bonds. And you could have, instead of having your money sleep, you could have had it working actively in fixed income, because they are totally opposite markets. It's when there's fear in the stock market, you go to bonds, and they're more the safe haven asset. So you can always be working your money either way. The commodities and the TSX are a little bit more commodity oriented. I don't have a graph to show you the Canadian bonds and the research done on that. This is a very limited free stock charts program, and I don't find much use of it. I can do what I want with it. And it gives you a pretty good indication of going to low MER index funds and that, and low MER bond funds and TSX low index those funds. As you can get exposure to resources in your portfolio, in your registered account. So as you can see, there's a nice rise, and you get your sell signal right here. And that's when you got your buy signal right over here. Or sorry, this is the ECRI when it went above 0 in 2009 and in the mid-range. So this is mid-range 2009. This is where you got your buy signal. Another way you can do this is through trend lines, but I don't expect you, the average person, to know too much about trend lines and using that as a way to kind of actively gauge or pull back some of your money from indexes and then place it in other areas to give you more of a hybrid approach to investing instead of just being heavily weighted in one index or one sort of asset class. So back in 2010, or sorry, 2011, you got a sell signal in about, we'll say August. You would have went to bonds because they're the opposite index. And you would have seen in 2011 there was a rush to bonds, and that never ended for about 2 or 3 years. And you would have gotten back in, you would have looked at the indexes and realized this is getting tough. And where's the next buy signal for the S&P 500? Well, it would have been easily right there. You would have got in just about in January of 2012. So let's look at January 2012 on the bonds to kind of weight yourself out of those bonds. You would have missed a little bit of a ride, but it would have been, you would have got out right about there. So it's high-powered money. A lot of what you're doing with the U.S. is you're dealing with high-powered money, and you do see sharp rises and that. And like I said, this is a 30-year index. This is a very sensitive index to yields and all that. It's the biggest gyrations. And I personally like to use a 10-year as a benchmark or a mid-range bond fund to get into. And plus one, that's the low MER. As you can see, there's not too much else to talk about. We did experience a back resurgence of getting back into the equities. And as we saw, we got another buy signal right here for on the ECRI weekly leading index, and that would have got you back into the U.S. index fund back in early 2016. You would have got your passive sell, and then you would have got another buy pretty much right after. Anyways, that's all I have to say about that. Hopefully I made sense and you can take something from it. Thank you very much for your time.